I'm not sure. Like, for example, when they're trying to ask you to write a journal entry, is it like you're supposed to write a journal entry in the exam, or is it like a posting in the exam, or
No, journal entry effect.
effect also you're supposed to say?
Yeah, effect. Just now, what happened to liability? What happened to ROI? ROU?
So is it like a full-fledged question wherein you'll be given adjustments, balance sheet, and then you're supposed to put past journal entries and put the addition to the this thing also?
And put the effect on that. Just now we answered, no? What is the effect on new ROU? What is the effect on new liability? How much it's going to increase? And the extracts. What's going extract of that account?
Okay.
Of course, they will not ask you to prepare. That's very elementary preparing. Balance sheet extracts, income statement extracts.
So after studying the entire IFRSs, I shall tackle the questions, no? Or
Yes, yes. Because in combinations they will ask you questions.
okay.
In that, IFRS 15, IFRS 16 must
And one group accounting.
group accounting.
Group accounting is that subsidiary, associate, and parent company.
Everything you added. Parent company means parent company consolidating subsidiaries where they have more than 50% controlling stake.
Then it's subsidiary. If it's less than 50%, it's an associate.
Associate and all those things when you added, that's a group. Group statements are not published. Consolidated statements are published. Okay, tell me about these events after the reporting period. What do you know?
I know it is IAS
It's a
10.
very small chapter. We'll finish today.
There are two kinds of. I know it is IAS 10, so there are certain transactions that you will be recording after the year end is done. So those are called adjusting events. Non-adjusting events are those events. The what do you call that? The event might have happened in this year, but you might be recording the effect in the next financial year. Is still
Okay.
yes.
Go ahead. Give me some throat rest. Read. This is only theory. Okay, definition.
Events after the reporting period. Events after the reporting period. Events after the reporting periods are events that occurred between the reporting date and the date of financial statements that are issued, that are authorized to for issue. There are two types of events after the reporting period: adjusting and non-adjusting. Financial statements are prepared on the basis of conditions existing at the reporting date.
At the reporting date. At the reporting date, some are adjustable, some are not adjusting.
Reporting date is like the when you prepare the financial statements.
Yes, generally year end. Mainly these for year end. Year end we have to be careful. Um,
Okay.
mm, Not month end and quarter end, etc. Mm, okay. See
Even
now this is a summary. Events which occur after the year end, but before the financial statements are approved. Okay, approved by after discussion. First, the auditors issue draft financial statements for the board. Hmm. For management will review, board will review, audit committee will review. After that, the audit partner is going to sign. Hmm. During that event, if they find out something which is a material, something which is immaterial, something which is existed in the year end date, something which is not existing in the year end date, which is existing in the year end, we have to adjust financial statements. We are coming to know now, but they have existed before on the date. And something which is not existed in the year end date, but it is coming to light right now. So, but it is going to impact the going concern, any other things, then what we should do? Mhm. See, generally, just imagine the time period. After the management closes its financial statements and issues that to the auditors for audit, let's say it takes 2 months for everything to finish audit, and then draft financial statements are ready, draft audit report is ready, then they will give it to management for comments, and it will go until audit committee, and audit committee, management and auditors discuss some differences. Hmm. During that time, auditors get a new evidence which has a effect on the year end date during this intervening period. Hmm. Then of course you have to adjust financial statements. Some new evidence but did not exist on the year end, but there may be effect of especially going concern concept. Going concern concept is reasonably the business is going to continue, and during that intermediate period of a discussion, let's say 3 months, 3 months before 31st December, and by 31st March they are getting into all these things. 31st March they are getting into all these things, but it has a bearing on 31st December. Of course, your financial statements must be changed. But something which is not existing on 31st December, we are coming to know on 31st March before signing, and which causes the going concern issue big question mark. Hmm. There might be restructuring, there might be some material adjustments required. Then it is a going concern, issue concern. The company may not be able to survive by the next year. Hmm. What to do? Going ahead, adjusting events. Go ahead.
Examples of adjusting events provided by IAS 10 include the sale of inventory after the reporting date. This gives evidence about the net realizable value of inventory at the reporting date. The bankruptcy of a customer after the reporting date, the confirms that an allowance is required against the receivable balance at the reporting date. The discovery of frauds or error. This shows that the financial statements are incorrect. The settlement after the reporting period of a court case that confirms the existence and value of entities' obligation at the reporting date.
So, sale of inventory after the year reporting. That's why auditors will do lot of, let's say 31st December, 1 week before and 10 days after. They check all the evidence, how the inventory is moving. This gives evidence about the NRV, because under IFRS IAS 10, lower of the cost are NRV. Hmm. And if NRV is less, you have to report at the NRV. Hmm. And we are coming to know that now. Hmm. So that means your inventory value after they tested for lower of the cost or net realizable value, maybe they concluded at a cost before. Now NRV is less and we have to conclude at NRV. Hmm. That is one. Then bankruptcy. This confirms the allowance is required against the receivable balance. Hmm. We provided certain bad debts, but that is not sufficient. Discovery of fraud and errors. Of course, material misstatements have happened. Hmm. And we have to adjust the financial statements. We have to reissue financial statements. The settlement, then examples of non adjustments. Continue.
Non-adjusting events do not affect any items in the statement of financial position or P&L and other comprehensive income. However, for material non-adjusting events, IAS 10 requires the following disclosure: description of the event and its estimated financial effect.
But what are those? Major business combination. Read that.
Major business combination after the reporting date of the disposal of major subsidiary, announcing a plan after the reporting date to discontinue an operation, major purchases and disposal of the asset after the reporting date, destruction of asset by fire after the reporting date, announcing or commencing a major restructuring after the reporting date, large changes after the reporting date, in foreign exchange rates, equity dividends declared or proposed after the reporting date.
In this also, there are two things. One is immaterial, material. Hmm. Material adjustments, of course, we cannot change the financial statements. These are not going to be found out now, but material events we have to disclose. Hmm. Immaterial events you can leave it. Hmm. Okay. Which one is the adjusting? Which one is non-adjusting? Insolvency of major credit customer,
Adjusting.
adjusting. Uninsured loss,
Adjusting.
uninsured loss,
Not
not adjusting because this is after the fact. Hmm.
after the.
After the reporting date.
Okay. Proposal of a final non-adjusting because it is also after reporting date. A change in foreign exchange is adjusting.
A change in foreign exchange rates.
Adjusting.
Why it is adjusting? This is after the fact. You already included at a certain exchange rate on the balance sheet date.
Right, but it is changing, no?
It
So
is
you can go
changing,
back.
it will keep on changing.
So you won't adjust it to a telling. We will only write it in the disclosure that this change is been made. And
If it is better, you have to disclose.
if it's immaterial, then you ignore.
Ignore. Anyway, you remember in consolidation and other things, we take average rate, etc. Right?
Yeah.
Hmm. And if that is going to change, then if it is material, disclose. That's it. Hmm. Next, going concern issue. This is a beautiful one. Hmm.
Going concern issues arising after the reporting date. There is an exception to the rule that the financial statements reflect condition at the reporting date. If after the reporting date, management decides to liquidate the entity or cease trading or decides that it has no realistic alternative to these actions, the financial statements cannot be prepared on a going concern basis. If the going concern assumption is no longer appropriate, then IAS 10 states that a fundamental change in the basis of accounting is required. In this case, entities will prepare their financial statement using breakup basis and disclose this fact. In accordance with IAS 1, presentation of financial statements, management must disclose any material uncertainties relating to the event or conditions that cast significant doubts upon an entity's ability to continue trading. This rule applies if the events have arisen since the reporting period.
Basically, going concern for an auditor is 1 year. 1 year after the signing the audit report. They should see that, okay, whether it is going to be affected if financial statements cannot be prepared. Hmm. If the going concern is no longer appropriate, then it says the fundamental change in the basis of accounting. So in this case, they prepare a using the breakup basis. Um, Up to this date, it was no problem. After this date, there is a going concern issue. Then there is the provisions. Hmm. Provisions is what? Long term, no? IAS 37. Hmm. IAS it's different from accruals. Accrual is for short term. Provisions is long term. And IAS 37 applicable. Okay? And all this since an entity has a present obligation, it is probable, reliable to estimate. Hmm. IS 37 requires the provisions are measured at the best basis. The range of, I think, min and maximum, and you should take the best estimate. If it is not possible, at least minimum loss you should provide it. Hmm. Okay, go ahead.
Clean sells domestic appliances such as washing machines on December 31st. Clean decides to start selling washing machines with a warranty. Under the terms of warranty, Clean will repair washing machines at no charge to the customer if the machines break within the warranty period. The estimates based on the past correspondence with the customers that 20% of the washing machines will washing machines sold will require repairs within the warranty period at an average cost of 200 per machine. Clean sold 200 machine. So in 200 machines, 20%. 40 machines will be at 50.
Dollar
20.
2000. Yeah? What's the entry?
Huh?
What's the journal entry?
For warranty,
Warranty provision.
so you'll create the provision for warranty. So
Warranty expenses debit.
debit to asset also you can put or to warranty also.
No, to warranty liability.
To
You should not credit asset.
because your credit asset is reducing.
That's why we are studying warranty liability is a liability.
Separate liability. It is not related to asset. It's not like how you do um, government grants. So government grants only we have like no, like you can either put it as a deferred liability or you can put it in asset. So that is not applicable
That is
here.
altogether different topic. Warranty, provision for bad debts, everything you credit liability first,
Yeah,
and
like
then when your company goes for repairs etc.
you
Debit warranty liability.
do
Then
asset.
no to cash. Let's say 500.
So when you do for bad debts, okay. So when you have this bad
Bad
debts
debts
and
to provision for bad debts. And provision for bad debts is the contra. You are just against the AR.
yes, so trade receivable 1,000 rupees there. So in that we already know that around 500 in वापस बरगा anta. Okay, let's keep 400. It'll get confusing. 600 वापस बरतनी, like it'll come back. So your first entry will be bad debts to TR. Trade receivables 400 400, right?
No. Warranty expenses to provision for, bad debt expense to provision for bad debts 400 400.
I thought on 600 you make the provision.
No, for 600 is you want to provide it.
No, I'm saying to TR we have 1,000 rupees. That we know that bad debts will be like we are assuming that our bad debts will be 400. The balance we are like okay we might get 600. Okay. Now when I'm creating provision, I will create it on 400. No.
400 is the bad debts or 600 is the bad debts you are doubtful debts you are getting, you may get or you may not get.
I'm saying 400 you may get or may not get.
Okay, then bad and doubtful expenses
Huh.
400
Yes.
to provision for bad debts 400. That means this provision for bad debts is a contra. Your TR is how much now? Trade receivable you said how much?
1,000.
1000.
Right.
And you adjust the provision for bad debts 400. Your net trade receivable is 600.
Now, what if I do not get 400? Okay, but I get three.
That is different. If you don't get the 200, you how much? 400.
Huh.
Provision for bad debts you debit 400
Yes. Two.
to TR
Two tier 350.
350 or 400 whatever.
Okay, this is when you get the entire amount.
Yeah.
Like
Suppose
400.
350 Suppose 300, you are sure you are not going to get 300.
You're not going to get.
Sure. The insolvency, they closed.
So you have to reduce your TR by 300.
Yes.
Because
Because this you write it off. You write it off. This crediting TR is write it off.
right.
Specific write off. Specific customer write off.
Correct.
Now if you do here only TR, that means you are following cash basis, which is not correct. Entire IFRS or gap is on accruals. See, provision for bad debts or provision for warranty is what? On a conservative basis, we are thinking we are
Yeah,
not going to get. Customer has, you keep on calling customer. If you
right.
tell customer I have provided for it, means they will not pay. This is your internal problem.
Yes.
So you continue to follow it up with your customer.
So now next, so in balance sheet and mine is this 300 from the net TR, no? Mine, then my actual TR will be 300.
300 with the current customers. Old customers, you remove them. This is provisions. But provision is a long term, accrual is a short term.
Okay.
Now here you provide for this is warranty expenses, may you give 2 year product warranty. In 2 year product warranty, you are expecting 20% will come back for
Yes.
repair. Now for 2 years you are providing now. As a cautionary approach, you are following conservative basis. Prudent, being prudent. So, with this warranty expenses, your or provision for bad debt expenses, your current year expenses are coming down. But this is future related.
Right.
Under conservative, being prudent, what is that? You can increase expenses in the current year. We are providing it for the future now. Increasing expenses, increasing liability, decreasing assets is what is accounting. Assets should not be overvalued, but liabilities should be overvalued.
Valued
Expenses should
under.
not be undervalued. Expenses we should provide. Future foreseeable losses we should provide.
Yes.
Okay, then subsequently, if a provision has been discounted to present value, because provision is a long term, it goes more than 1 year, then you have to show it under present value. The discount rate must be used unwound and presented financial cost. So earlier discount must be unwound and then presented in a finance cost and the statement of profit and loss account. So you show it as a finance cost. Provision should be remeasured to reflect the best estimate of the expenditure required to settle. Then you have to show de-recognition. Uh, Provision should be used only for expenditure that relates to the matter for which the provision was originally recognized. Hmm. Provision should be reversed if it is no longer probable that outflow of economic, like for example, some 400, 300 left or something, and that is the purpose is over. The purpose is over. You got everything, then you reverse it. And provision account is never, you should not keep it as a never ending. Once you provided for that purpose, once that purpose is over, you should reverse. Then contingent liability. IS 37, possible obligation that arises from past events. and whose existence will be confirmed by the outcome of uncertain future events in the future that are outside the control of the entity. Present obligation resides from past events but does not meet the criteria for recognition as provision. So, this is a contingent liability, contingent on certain events happening, like legal cases, classic example. Legal cases, the outcome, whether your company loses the case or wins the case, it is how to provide it. Hmm. These all depends on the event that's going to happen or not happen. Hmm. You cannot just provide it. Hmm. Not all items meeting the definition of an element are recognized. That is contingent liability. Recognition in the final would not provide a faithful representation. Depending on the nature, this might be because there is not enough certainty. The probability of an outflow is too low, and the level of measurement uncertainty too high. You should not unnecessarily provide contingent liabilities that decrease your expenses hmm, and increase the liability. Hmm. So, uh, and that depends upon three things. If it is a remote probability, ignore, don't provide. If it is possible, then disclose, don't provide. If it is possible, you can provide. Probable, sorry. There are three conditions: remote, possible. For remote, ignore it. For possible, disclose it. For probable, you can estimate the loss, range of loss. Yes, you should provide it. For example, legal cases is going on. Product liability cases are going on. Taking your legal counsel advice, you have to see whether the IAS 37 says whether it is remote, whether it is possible, whether it is probable. Remote, don't provide it. We don't know. Your legal department is telling there is a likelihood is we cannot. Hmm. We cannot say whether we are going to win the case or lose the case. Possible, yeah, 50-50. Probable, yes, 70-30. In that case, you should disclose and as well disclose with a detail, and as well as you must provide what you will provide. Uh, you will come out with a minimum and maximum range. Hmm. In between, you provide best estimate. Best estimate as the loss.
Right.
If it is not possible to arrive at a best estimate, you provide minimum and explain in the details, detailed notes and disclosures. And even contingent asset is same. Even remote you should ignore, possible you should ignore, probable disclose. There is no need to provide a contingent asset. Contingent asset is a possible asset that arises from past events and whose existence will be confirmed by uncertain future events that are outside the entity's control. Contingent assets should be disclosed if the inflow of future economics is at least probable, if the future inflow is virtually certain, etc. Read this.
Future operating losses, IAS 37 says that provision should not be recognized for the future operating losses because the loss is related to future rather than past events. Then the loss-making business could be closed and the losses avoided, meaning there is no obligation to make the losses. An expectation of future operating losses is an indication that assets may be impaired. An impairment review should be conducted in accordance to IAS 36 impairment of assets.
Future repair to the asset, etc. Go here. Read.
Danbar, a company that owns several shops, has the year end of 31st December 2x. One of the shops is a loss making. At 31st December, Danbar forecasts that this shop will make a loss of 50,000 in the year ended 31st December 20x2. As of 31st December, one of the shop buildings require repair. The cost has been estimated at the reporting date at 10,000. The repair is made in the following accounting period at a cost of $12,000.
So, which one we should provide?
10, no, because you're keeping.
As on X1. What about that second paragraph? Anyway,
Not
this is a future, right?
right.
We cannot provide that. Hmm? And uh, cost has been estimated, right? At 10,000. Huh? Estimated means what? It is 1 minute. What is the definitive here? 10,000 or 12,000?
Estimate is 10,000.
But
Actual was 12,000.
so for that 12,000 you should provide. More you should provide. That's the funda. Expense more, liability more you should provide.
Because I thought we're providing minimum. So I thought 10 is the
No,
minimum.
that is best estimate is what 12,000 in that case.
We actually know how much we paid, so it's 12,000.
12,000 you should provide. Minimum yes, but this is the best estimate. Best estimate is possible here.
Yes.
And also this is actual.
Right.
Repair is made. So you provide that 12,000. So for 12,000 you provide. And by the way, 1 minute. This somewhere we studied contingent assets. Contingent liability is for expenses, of course.
So this is for income.
And this is for income. If the case is successful, and this is for income. Income we should not provide at all. Because same thing, expenses you can provide, liability you can increase, assets you should undervalue, and income should never be recognized until it is realized. Okay. Then what is it? These see already I talked about it. Best
Yes.
estimate and other things. These are simple things. Environmental provisions, cleanup costs, if past events has occurred, merely causing damage is not create an obligation. Full cost of environment should be recognized as soon as the obligation arises. If the expenditure results in the future crime, then an equivalent asset can be recognized. Da, da, da. Let's finish this last question. The other things are not so important.
An entity has a policy of only carrying out work to rectify damage caused to the environment when it is required to do so by local law. For several years, the entity has been operating an overseas oil rig which causes environmental damage. The country in which the oil rig is located had not has not had legislation in the place that required the damage to be rectified. A new government has recently been elected in the country at the reporting date. It is virtually certain that the legislation will be enacted that will require damage rectification. The legislation will have a retrospective effect. Provision, explain whether provision
Then you
should.
should provide. You should
Yes.
provide. right?
Yes.
Earlier you were careless because the laws were not there. Hmm?
Right.
Now you have to provide.
Under a license granted by a local government, an entity has constructed a rock crushing plant to process material mined from surrounding area. Mining activities have already started under the terms of license. The entity must remove the rock crushing plant when mining activity has been completed and must landscape the mined area so as to create a national park. Not required, no.
Rock crushing plant, it will affect the surrounding area. Entity must remove the rock crushing plant when mining activities have been completed, but landscape so as to create a national park. Mm, okay, in my view, we should provide for something.
Is it because environment is getting disrupted?
Disrupted, and cost of rectifying.
Will be high.
Mm. And cost of rectifying should be provided. Okay, that's it. This is an interesting area. We covered